Are you a beginner in stock market and wondering how to read candlestick patterns in the stock market? Uncertain how to make sense of those colorful bars dancing up and down on the screen? Dive into the world of candlestick patterns and technical indicators where the seemingly complex becomes beautifully simple. Embark on this journey starting with the candlestick pattern. A candlestick, in essence, is a visual representation of the battle between the bulls and the bears in the market. It consists of four main components: the open, close, high, and low. The body of the candlestick is formed by the opening and closing prices, while the wicks or shadows represent the high and low prices during that period. In the domain of candlestick patterns, two are particularly noteworthy: the bullish engulfing and the bearish engulfing. The bullish engulfing pattern transpires when a tiny red candle is followed by a larger green candle that entirely engulfs the previous day's candle. This indicates a potential reversal from a downward to an upward trend. A classic example from the Indian stock market is when the shares for Reliance Industries displayed a bullish engulfing pattern in July 2019, indicating a strong upward trend that persisted for the following weeks. On the other hand, the bearish engulfing pattern is exactly the opposite, signaling a flip from an upward to a downward trend. A prominent instance of this from the Indian stock market is when the Infosys stock showed a bearish engulfing pattern in October 2020, pointing to a significant downturn that followed. Next, venture into the world of technical indicators, mathematical calculations that help analyze historical price, volume, or open interest patterns to predict future market trends. The moving average, relative strength index, and Bollinger Bands are three popular technical indicators. The moving average, often used to identify price trends, is calculated by averaging the closing prices over a specified number of periods. A rising moving average indicates an uptrend, while a falling moving average suggests a downtrend. The relative strength index, or RSI, on the other hand, measures the speed and change of price movements to identify overbought or oversold conditions. An RSI above 70 suggests an overbought market, while an RSI below 30 indicates an oversold market. Bollinger Bands, comprising a middle band with two outer bands, work on the principle of standard deviation. The band expands and contracts based on market volatility. If prices touch the upper band, the market might be overbought, and if they touch the lower band, it could be oversold. In essence, candlestick patterns and technical indicators are tools to decode market trends and make informed decisions. Remember, the bullish and bearish engulfing patterns indicate potential reversals, while the moving average, RSI, and Bollinger Bands help predict future market trends. However, these tools should not be used in isolation. Always consider other factors such as market news, economic indicators, and your risk tolerance. After all, the stock market is not just about numbers and patterns. It's about understanding the underlying dynamics that drive these numbers. So, next time you see those colorful bars dancing on the screen, you'll know they're not just random movements. They're telling a story of the stock market's ebb and flow. And you, with your newfound knowledge, are equipped to read and understand that story. In the world of stocks, knowledge truly is power. So empower yourself, uncover the secrets of candlestick patterns and technical indicators. And who knows, you might just find yourself dancing along with those colorful bars.